Hi everyone. I just want to recap on the Eurodollar eighth outright versus the 5 year. So the 5 year US TED trade. It's Monday, 25th of April. Sorry it's late in the day. It's about 20 to 8 in the evening. But I thought I just wanted to reiterate the most important parts of this trade. There's many of you trading this. There's many of you looking to trade this, and I really want to, reaffirm some important parts of this trade. Now, this particular trade was traded very actively by props in UK and the US from around 2002 to about 2006. So most of those guys would be trading this TED trade without any understanding of actually where their edge came from, right? So they were trading this Eurodollar versus the 5 year, or Eurodollar versus 2 year. In this case, we're talking about Eurodollar versus the 5 year. The most important thing was they didn't understand, these traders, and there were many, hundreds of them, right? So across London and Europe and the US, who were trading this trade, and they just simply didn't understand where their edge came from or what type of risk they were taking. So slowly but surely, when the market started to change cycle, you started to have credit impacts, curve impacts, where things didn't just sit in a range, and buying 70s, selling 80s was a great trade, and things changed, right? And things changed, I think it changed just purely because of the dynamics of the trade, right? So I know many people who knew how to trade this trade and had their best years when the curve moved most and the credit spreads moved most, right? So I think this is a very good trade. I think it fits perfectly within an OSTC trader's arsenal. And I'm going to go through the slides to be able to go through and talk again through some of these points, right? So the Eurodollar eighth outright future versus the 5 year, and I've overlaid this in the scatter plot versus the 2s, 10s interest rate swap spread, right? You can replace this with a US 2 year, 10 year future spread, right? So what I've done here, I've overlaid, and you can see the scatter plot, I've overlaid where the Eurodollar 8 versus the 5 year, so the 5 year TED is trading. You can see on the verticals trade from 274.35 up to 60. And what you can also see is down on the horizontal, you can see that's 2s, 10s in yield terms of the 2s, 10s interest rate spread. Now, why I always talk about outrights up, curve this, etc., right? I think from a trading perspective, we just look at the bund, right? Or we look at the 10 year, or we look at the gilt, and we think, right, how that impacts our spreads. Now, that's fine, right? You can do that, and there's nothing wrong with doing that. However, there becomes a problem with that when the market starts to change, where the bund goes down and the curve goes down, the gilt goes down and the curve goes down, or the treasury, which is more likely, goes down and the curve goes down, right? So it's really important to understand what drives the products that you trade. Now, I'm just talking about the Eurodollar 8 versus the 5 year, but we could be talking about many of the spreads down the curve, and hopefully you send me emails and say, Malcolm, I want you to talk about this spread, right? So, but right now I'm going to be talking about the 5 year TED spread, right? So let's say, for example, what I've done is on this is a scatter plot, right? So every time there's a print on the 2s, 10s on a daily, it will print where the Eurodollar 5 year or the 5 year TED spread was, right? So with the two, they're not quite perfectly parallel, but the two black lines you can see, going up there and going up there with the two black lines, you can see that there's a clear correlation between the two products, right? So if you can't see that, so when this 2s, 10s treasury spread, which is along the horizontal, starts to go higher, what you see is a higher trajectory of the Eurodollar 8 versus the 5 year, i.e. the 5 year TED, right? So what I've done here I've put a green box around where the 2's 10 is traded 104 to 106, moved moved where the 2's 10s is traded up to like 105.5 to 107.5, and what you can see is, surprise, surprise, the Eurodollar 5 versus the Eurodollar 8 versus the 5-year note future is trading higher, right? So what you can see is golden rule number one is that if the curve, if 2's 10s goes higher, your 5-year TED spread will go higher, right? It will trade in a range, right? And we'll look at that later in the presentation. It will trade in a range, but you will have a noticeable trend going higher, right? So let's look at the next part. What I'm looking here, very similar, a little bit more obvious in terms of the trajectory of the spread. So this is the 5-year US TED spread, same spread, versus the Eurodollar whites greens pack spread. Whites greens pack spread is essentially the white pack, as you can see here, M6, U6, Z6, H7, i.e. the front 4 outright contracts, divided by 4, minus the greens, so the June 8, June 9, Dec 8, March 9, divided by 4. So this is a big long calendar spread, big part of the curve. So from your front contracts to the greens. So basically like a 2-year part of the curve, right? So what you can see here, you may or may not know, what I've done is for here, like, so on the bottom, I've got the whites greens pack spread as a price. So down the bottom, so this is 1.5, this is 1.6, and this is 1.85. Again, the same vertical. 274.35 on the 5-year TED spread to 274.60, right? So what you can see with these black lines, which are you can see clearly if the whites greens pack spread is going higher, i.e. the whites to greens Eurodollars is going higher, you will see the Eurodollar 8 versus the 5-year, aka the 5-year TED, going higher, right? So it will move. Whether you're short or not, it will move. Okay, so what I've done here is put this green box, said, right, so if it's trading 1.5 to 1.6-ish, if it moves up to 1.75 on the whites greens pack spread to 1.85, you will start to see, or you will relocate in the Eurodollar or the 5-year TED spread. It will trade higher, right? Whether you're short or not. And so let's move on to the next one. So clearly the 5-year TED spread direction has much to do with the direction of the Eurodollar yields and the US Treasuries, right? So now I'm going to talk about the outrights. Now, right now, the outright direction and its impact on the curve is the 10-year note Treasury future goes down, the whites, the greens, or the 2's, 10s will go up. So the Treasury, the curve will go up. This is very much like the Bund's impact on the Euribor spread. So if the Bund goes down, the Euribor, say June 16, June 17 spread will go up, right? So what I've got here, on the bottom line, I've got the Eurodollar H9, so the March 2019 outright, so quite a way out, so it's a little bit more volatile. And what I've done here is plotted every time I get an end of day plot in the Eurodollar March 19, is where is the 5-year TED spread, right? So what you can see with these black lines here, you can see a clear inverse correlation, where you saw in the previous correlations, let me shoot back, there was a positive correlation, i.e. if the horizontal went up, you see an upward move in the Eurodollar to the 5-year spread. Conversely on this, so if the outrights go up, you see actually the Eurodollar to the 5-year go down. You know that, right? So you look at the Bund, you look at the gilt, if that goes up, your white spreads, your June 16, June 17, and all the flies and combos in between, they start to have a downward pressure. right? So what I've done here is I've said, right, in this green box, I've said if the euro dollar March 19 outright is 98.52 and that starts to trade 98.54, what happens to our euro dollar versus the 5-year spread? Now, what happens is it starts to trade lower. The beauty of this trade is during economic releases, during volatility in the market, first thing in the morning, last thing at night, when people are exiting positions, you will get opportunities to put on this trade where it shouldn't be, right? So this is why I'm telling you is how to spot an opportunity. So let's move on. So quite clearly, if the structure of the 5-year TED is made to represent a curve structure, we need to know where the curve is at any time if our spread is valued fairly, rich or cheap, right? So i.e., do we go long, do we go short, or do we do nothing, right? So this is how I look at everything, right? So, and these bottom charts were not fudged. I just took a snapshot about half an hour after doing these ranges. So this is how I trade, right? So what I want to do is not give you the levels to trade, but more is to say, right, give you the material so that you can go away and trade this yourself. So what I've done is, I talked about on the 3 previous slides about correlations. If the outrights go up, how does it impact euro dollar to the 5-year, i.e. it goes down. If the 2's10 spread goes down, i.e. it will push the euro dollar to the 5-year, i.e. the 5-year TED higher. So what I've done here, these are rule of thumbs, right? They're there to be broken. Every rule is there to be broken in trading. Don't get me wrong, everything will be tested at some point. These are rules of thumbs. If you're looking at this from a first point of view, first trade, what do I do? Right, so here we go. This is the euro dollar March 19 outright. So if we're in a 98.50, and I took these from the scatter plots here, if we're in a range of 98.50 to 98.52, the TED spread, the euro dollar 8 versus the 5-year, should be in a range of 274.45 to 57. Right now, let's go back 2 years. Let's say 2 years ago, the March 19 outright was 98.50 to 52, right? So that would have very little significance on our range of our euro dollar 5-year TED spread right now. What we need to look at is the very short term, right? So we look back month, 2 months, and we look back where if the euro dollar March 19 is in this range, where was the 5-year TED spread? Where is 45 to 57? And as you start to go to the right hand side, the TED spread starts to go slowly lower and lower. So hopefully what this can do is a few things, right? You can start to look at, right, I want to, Malcolm's, he's talking about this spread. Let's see if he's right? I know for one thing that 45.57 or 42.55, that will be tested. But the general trend to the right hand side, i.e. the outrights go higher, this TED spread gets lower, absolutely. I'm confident in that. So let's look at the 2's, 10s and the white screens. Same principle. I took these ranges from the recent ranges of where the 2's, 10 spread was and the white screens pack spread. Why have I done that? Because that gives you an idea of the type of ranges, the type of direction these spreads should trade. Okay, it's not to say these are set in stone, but if you're a new trader, you look at white screens pack spread, it's trading 170 to 175. Malcolm says, the chart says, the data says that the spread should be trading 274.43 to 53. Is it at the bottom of that range? Is it at the top of that range? Is it out of that range? That should raise alarm bells, right? So, and this is where the market was, right? So if you look, okay, so this is our TED spread down on the bottom. It's 274.56. That's this price here. I apologize about the graphics. 274.56. Right. And then our white screen's pack spread, I know you can't see it, is 180, right? So if this is here, the white screen's pack spread is 180, which is around the end of this area here. What you can see is that, and I said it's 274.56, it's about right. It's at the top of this range, and it's at the top of the range, right? So then what you do. So I don't know if any of you have heard about conditional distribution. So conditional distribution is a way in which to look at the market. And believe it or not, you already look at the market conditionally about, let's say the Bund is trading 162.10, the Bund goes to 162.50. Subconsciously, despite the fact that you don't look at the market conditionally, using conditional distribution, you will think in your mind, well, the Bund was last 162.10, it's now 40 ticks higher at 162.50. The last time it was trading 162.50, my spread was trading at 1.5 ticks lower. And that's the type of way to use this, right? So what you have here is the middle bit of here's the 2-10 spread. It's trading 106 to 107. Okay, so here we go. 107, 107, 274.56, right? So it's at the top of the range of that. Okay, and then let's just look at the outright, which is probably the most dirty of all the indicators. If you see the outrights, that's trading down at 50, right? So look, okay, so where's 98.50? Again, so it looks like the US 10 spread is at the top of its range, right? So why is that? What you can see is that you've got a downward pressure in treasuries today, and that's putting pressure on the upside on this trade. There's one caveat, right? So one caveat, swap spreads. So what I took a quote from BNP Paribas on the recent move in the swap spreads. Now, as you can imagine, interest rate swap spreads are the difference between interest rate swaps, like so interbank or commercial money, versus the cost of borrowing money for a treasury or a central bank, right? So the normal thought is that central banks can borrow cheaper than interbanks, i.e. commercials. But post 2008, so in the Lehman crisis, what you had was, in the Lehman crisis, you had a scenario where the central banks were backstopping the debt of banks, right? So that gave them a better credit quality than what they had before or during 2008. But also what you had in the next couple of years post 2008, what you had was a downgrade in US sovereign debt. So you had a central banks that were backstopping non-central bank debt, non-sovereign debt, which was going to be good for the banks. And then you had a situation where AAA rating of the US Treasury was took away, right? So what you've got is a scenario that actually banks' debt is trading high. Banks can borrow cheaper than the US Treasury, right? So it's completely abnormal, right? So this is the comment. So the collapse in US swap spreads has caused considerable consternation in the US rates market, but it's shown little sign of abating. I can tell you right now, the US swap spreads in the 30 and the 10-year went inverted about 4 or 5 years ago, and they haven't retreated, right? So in BNP Paribas' view, the drivers of negative swap spreads are primarily regulatory, which are frustrating fair value models. So regulatory driven hedging costs, balance sheet charges, supply and demand, they believe, and a lot of the market believes, because of course these swap spreads haven't moved, is that they're going to remain negative for a very long period of time. Now, how does that impact you? Well, you probably don't care too much, What we should be caring about is the short-term price action, right, and supply and demand. This is the most important thing you will hear in this presentation, right? So this is the most important thing you'll hear in this presentation. For every 1 basis point up move, so 1 basis point, this number here, which is minus 4.26, if that moves to minus 3.26, so it goes up 1 basis point, it will move your Eurodollar to the 5-year down 4.5 to 5 ticks lower in the spread. Simple, period. Right? So this is where people fail in swap spreads, i.e. they fail in TED spreads. Conversely, if you see a move down in the swap spread by 1 basis point down, it's minus 4.2, it goes to minus 5.25, it will move your swap spread 4 to 5 ticks higher. So, regardless of what's going on in the curve, you need to see what's going on in the swap spreads. Now, hopefully this has been useful. I'm very passionate about this spread. I believe strongly in the way that it could be used. Please send me any questions and good luck. This is a very, very good trade over numbers. The prices get dislocated, and just to let you know, I just looked at the number. This is right now. I'm going to put it here. You know, we talked about 274.56. It was too high. It's trading 274.53. Right? That's just nonsense and noise, but that's where it is. Thank you very much.